Hi, this is Kerry Artak with Wicked Stocks, bringing you an update, a much-needed update in the iShares 20-year Treasury Bond ETF. That is the TLT. This is, I think, the most relevant Treasury indicative ETF that you can trade. In other words, it is inversely correlated to longer-term interest rates, as you're probably well aware. And in the last video that was it was about 2 months ago, the middle of September, I'd mentioned how we were still in the midst, if you look at this chart, of a near-term buy signal. When we settled above that 95.09 at that time, middle of September, a descending channel top dropping 18 cents a week, that we were expecting a test in the next several months. We were about 2 months into that. It could have been, did not actually pan out that way. I'll show you in a moment. It could have been within a matter of weeks of reaching for that 104.56 four-year channel top. It is that descending four-year channel top at 104.56 that is our trend-defining structure on the TLT. In other words, the longer-term interest rate environment remains one of higher rates over time, longer term. Now, in the midst of that, we can get lower rates, as we've seen since the spring, or we did see, I should say, since the last April, May, interest rates dropped. We did not test that 104.56 channel top. Had we tested that 104.56 channel top, I would have recommended it, and I actually did recommend it as a solid zone to sell into if you trade the TLT. Now, I like to present these videos because I think they give a good view of the longer-term interest rate dynamic. What is the trend? What can we expect? And bottom line with this photo, this image, which I'll move from in a moment, is that the longer-term interest rate environment remains one of higher rates as we continue into 2025, holding below 104.56. Now, that 95.09 channel top, I also mentioned in the last video that if we settled below it, dropping 18 cents a week, that would set off a likely higher rate environment in the weeks and months ahead. Let me get to that actually right now. I'm going to open up this chart here. And actually, this is the same exact chart. I can show you that it was 3 weeks ago that we settled below that descending channel top. And this channel top, goes really back to October of 22. So this is a 2-year structure in itself, but it is not as significant in terms of trend identification as the 102.83 descending channel top. So both of these are dropping. The 102.83 four-year channel top dropping 34 cents a week, and the 2-year channel structure dropping 18 cents a week. We settled below the 94.18 structure several weeks ago. That indicated likely bearish continuation into later year, as I said in the last video that was in September. And by that, I mean likely progressively higher, longer-term interest rates as we continue into later year. Let me jump to another image and just show you that we also, the very same week, 3 weeks ago, that we settled below the 94.18 channel top, we also settled below a rising channel bottom that is now at 94.38. And this 94.38 formation is the one that I'm using as our sellable resistance. In other words, this is the formation, 94.38 rising 29 cents a week, that I, if tested, would recommend selling into through the rest of the year. Because I'm going to go back just a little bit, following the failure, that is the trend failure, you had a buy signal above 94.18. We rallied off of that for a couple of months, and then we fell back below it. And, I always see that a failure to follow through on a classic longer-term buy signal, as this was, but at the time, you've got to put it all together subjectively. Yes, this is a long-term buy signal by closing above a 2-year channel top, but you've got the sort of the 800-pound gorilla is the 4-year channel top. So this was considered, in the proper context, just a near-term buy signal up to the 102.83 formation, which we failed to reach. The high was actually in the middle of September, the very week that I put out the last video of 101.64, and we've fallen away ever since. So that settlement back below this channel top is a sign of weakness in and of itself. So I'm using the 94.38 formation now as sort of the area that if we rally back up to it, that is your opportunity to go short the TLT in anticipation of, and this is kind of a blown up chart, holding below 94.38, I am expecting what I would call kind of the low to upper 80s. And these are classic horizontal channel structures, both of which are rising 3 cents a week. 88.07, I call this a 1 to 2 month target right now. Holding below 94.38, I see 88.07 in reach by the end of the year. And of course, if we test 88.07, you can assume that the longer term interest rate market is even higher than it is right now. And this is a zone, 88.07 all the way down to 83.88, that may well absorb selling through all of the first quarter. And we can round up from here. 83.88 would be expected within 3 to 5 weeks of closing below 88.07. But this is a big area that could contain quarterly selling pressures, possibly into the middle part of 25. We could from here rotate back up to the 102.83 formation within 3 to 5 months of testing the 83.88 to 88.07 area. So the way I would frame this is we are in kind of a near-term higher interest rate dynamic. Below 94.38. Interest rates should continue climbing as we continue into later year, into later November, into December trade. This 88.07 formation likely over that time frame, the beginning of a wide zone down to 83.88 that can contain TLT selling through the first quarter of 25, possibly in the middle part of next year. This is kind of the big picture if we are to back out of it. And in fact, I'll just jump to the last slide. And this is what I see as kind of the long-term interest rates. The long-term Treasury bonds, obviously are inversely correlated with the interest rate environment. And they are a key element in determining interest rates, obviously, on the long-term scale. So holding below 102.83, we've got 83.88, 88.07 in reach over the next few months, let's say, possibly the next 3 to 5 weeks. This 83.88 to 88.07 area, both rising 3 cents a week. You can monitor these through time. This is an area to take profits if you're short the TLT and to consider going long, because from here we can round back up, and within 3 to 5 months of testing, let's just call it the 80s, we can round back up into the low 100s within 3 to 5 months. 102.83 is the key overhead resistance area that we need to settle above to indicate an end, really, to this sort of longer term cycle of higher rates that has plagued the market really since the March of 2020, the beginning of COVID. So here we are. Is there anything else for me to say? I don't think so. I think that pretty much summarizes it. I'm going to leave it at that for this particular update on the TLT. You have a great day.